Okay, good day, everybody. Hope you're having a good day. Today, we're going to continue on in Chapter 12. We'll be discussing control risk assessment to start with. The other day, just to overview what we did, we started talking about the purchase payable payment cycle, and we understood the various activities that occur within that cycle. We then also talked about the various controls that should be in the accounting system for that cycle. So we talked about things like authorization controls, controls with respect to custody of assets in particular, such as cash and inventory, controls over the recording of transactions, and periodic reconciliation itself is a control as it is in the sale revenue receivable receipt cycle. We also mentioned that various management reports are produced by IT systems today, which can give the auditor evidence with respect to transactions that may look incomplete. And so we can use the information in those management reports to guide us in terms of possible additional testing that we should do as part of an audit of a organization. So today we want to move ahead with respect to control risk assessment. And always remember, the reason we are doing an assessment of internal control risk is that our assessment will determine the nature, the timing, and the extent of the substantive audit procedures that we're going to do. Again, nature of substantive procedures, that relates to what's going to be the mix of test of detail, meaning that we go back and look at actual accounting documents, and or analytical procedures, which we said is doing ratio analysis and comparison of balances between accounting periods. Timing, how much of the work can be done before the end of the year, how much of the work needs to be done after the client's year end is completed, and then the extent, how many items do we need to look at. Okay, so we're going to talk about the various accounts that exist within the purchases payable payment cycle, and we see a list here. So again, these are on page 521 if you want to follow along with respect to our discussion today. The various accounts, inventory, of course, when we purchase things, part of what we buy could be inventory. When we purchase things, part of what we buy could be property, plant, and equipment, capital assets. Older term is fixed assets. And of course, we could also buy intangibles such as goodwill, patents, copyrights, licenses, those types of things. When we purchase these assets which are depreciable, the calculation of depreciation and amortization expense is part of this cycle. And of course, as we record depreciation and amortization, we know that we accumulate those amounts in accumulated depreciation or amortization accounts that relate to the corresponding capital assets. With respect to this cycle, when we purchase things, we know there are accounts payable, which are created. Sometimes notes payable if we can't pay an amount on time, we might get extended payment terms. So that would be represented by a note payable. Eventually, of course, we do have to pay our suppliers, right, or repay money that's been borrowed. So we do that normally with cash. And then, of course, as we purchase things, they may not also be assets, but they may be ongoing services that we're acquiring. So we may have to pay for selling expenses, such as meals and entertainment expenses, sales commissions, those types of expenses, manufacturing costs, of course, various types of overhead, property taxes, insurance payments, right, on buildings. So lots of things that we're paying for. And of course, just various administrative expenses, paper supplies, computers, all those types of things, right? So this cycle, of course, involves a lot of different purchase activities in a normal business that's being carried on. So as we saw in the revenue receivable receipt cycle, within each of these cycles, we have what we call general control considerations. So these are controls within the environment, right, within which the purchase payable payment cycle is occurring. And most often, these general controls are very similar, or in fact, in some cases, the same controls from a conceptual viewpoint that exist in each of the other accounting cycles. So we've already talked about the revenue receivable receipt cycle. So the first point that we see listed here in this PowerPoint is segregation of duties or segregation of responsibilities. And we saw this in the revenue receivable receipt cycle. So within the purchase payable payment cycle, there should be segregation of duties between persons who are involved in authorization. So authorization of purchases, custody of assets being purchased, the recording function with respect to recording items purchased, payables, and payments, and then the reconciliation process we mentioned should be done by persons independent of these other functions. So the idea here, in order to have the best control, right, within an accounting system, you want all of these duties, authorization, custody, recording, reconciliation, done by persons, by different persons, not by the same person. And as is pointed out here in the PowerPoint, persons who have custody of assets, so physical control over assets, and have the opportunity to record actually authorized cash disbursements should not be doing the accounting, right? Because if you can physically control an asset and then also control who is paid for the asset, right? That's dangerous because in the business, you could actually have physical control over an asset, set up a dummy company, and then pay that dummy company for the asset or service acquired. And in actual fact, this is how many frauds occur. We've had some frauds locally here in recent years where the bookkeeper involved was able to steal money from the company because of exactly this reason. Okay, poor segregation of duties, one person doing too many things. And in one case I'm thinking of, a person was able to actually steal money from a hospital because they were involved in the accounts payable department. Okay, so accounts payable is part of the purchase cycle. And in addition to, of course, paying suppliers, this person also had the authority to add a new supplier to the computer system. So what this person did was they added a dummy company onto the supplier list, and then they started having checks written to their own company. So over a period of years, of course, stole thousands of dollars from the hospital. Eventually it was discovered, but of course it was a situation which arose because of poor segregation of responsibilities. Internal controls, if we're going to rely upon them, they should provide evidence, okay? We need to have evidence that the control is working. We just can't say it's working. We need to have some type of evidence that we can go back to prove that it actually was working. So the typical thing you would have would be, as people perform internal control procedures, they'll sign documents or initial documents, okay? You may also, of course, have physical security over assets, so vaults, locked rooms, okay? And then, of course, you may actually have policies and procedures in place, which you can determine after the fact whether the policies and procedures were followed. So they give us an example here. It says accounts payable are recorded only when all the supporting documentation is ordered. So it's in order. So what they mean by that is that the purchase order for items has been matched to the receiving report, so the items that got delivered. So did we receive what we ordered? And both those documents are then matched to the supplier invoice, right? So the most common control over accounts payable is that those three documents must be matched before a liability is even recorded. So when a payment occurs, we can actually trace back in the accounting system, right? And say, are the three documents matched or not, right? It's very easy to determine. And usually when they're matched, someone will initial, right, on the documents that they have been matched. Okay, so we can trace back and determine in hindsight whether the control in fact was working or not. Now, when we test internal controls, we need to ensure that all of the control objectives are tested. So if you look at page 523 at the bottom of the page, it's exhibit 12-3. you'll see a list of internal controls on the left-hand side. So we're talking about the first one says recorded purchases are valid and documented. The second one, valid purchase orders are recorded and none omitted. Okay, so these are the control objectives. And to the right-hand side, you see the specific controls within the purchase system that should occur to meet those audit objectives. Okay, so as we see here in the PowerPoint, it's talking about a couple of these. With respect to inventory, remember inventory is in the purchase cycle. Cutoff is very important, right? Because we know inventory affects the cost of goods sold calculation. Cost of goods sold is beginning inventory plus purchases minus ending inventory equals cost of goods sold. So if we change that ending inventory because of improper cutoff, that's going to affect our cost of goods sold, which means it will affect our profit for the year. So if management wants to inflate their profit and make it higher, right, what they should do is overstate their ending inventory. Because if ending inventory is a larger number in the cost of goods sold model, that will make cost of goods sold a smaller number. If cost of goods sold is a smaller number, then profit will be higher. Right? So manipulation of inventory through improper cutoff is a common way for management to attempt to inflate their profit for the year. Now, as we saw in the revenue receivable receipt cycle, we saw something called dual direction testing. So this just means that we test in two directions, okay? And they talk about this at the bottom of page is this, 525, okay? There's an example there where they're talking about direction of testing. And we, depending on the audit objective that we want to verify, completeness or validity, okay, that will tell us the direction in which we want to perform our test. So for example, in the purchases payable payment cycle, in order to determine whether an expense is valid, right? So if we have, let's say, property tax expense recorded in the general ledger, is that a valid expense? Does it relate to the business? Well, then we trace where? From the general ledger expense account back to, right, the invoice from the city or municipality, and we'll look at that invoice for property taxes, right? So we're tracing in that case from the general ledger where an expense has been recorded back to the original document, okay? If we wanted to, let's say a piece of machinery was recorded as an asset in the general ledger, is that a valid asset of the business? Well, we would trace from the general ledger where the asset has been recorded back to the supplier invoice, right? To verify, yes, the recorded purchase, in that case a machine, is a valid transaction of the business. We trace back from the general ledger to the original accounting document. On the other hand, if we want to test for completeness, how would we test for completeness? Well, we would, completeness means are all invoices from suppliers recorded. So in that case, what we would do is go to the various supplier files that the client would have and select a number of invoices from suppliers and then trace from the supplier invoices into the general ledger to ensure that all the invoices that we have selected from suppliers have in fact been recorded. If they have all been recorded, that tells us, gives evidence that all invoices received from suppliers are recorded. So that would give us audit evidence that accounts payable are not understated, right? So depending, the important point here is depending on the assertion, right, that you want to test, you have to make sure that your audit test is going in the proper direction. So in my example, the issue is if you want to test validity, in which direction do you test? From the general ledger back to the invoice from the supplier, or from the invoice from the supplier to the general ledger? Which direction? Again, it depends on the assertion you want to test. If you're testing validity, as we said, you trace from the general ledger back to the supplier invoice. If you want to test for completeness, you test from the supplier invoices into the general ledger, right, to make sure that all of the invoices have been recorded. So directional testing, very, very important. Now, on Exhibit 12-4, referred to here as well, Exhibit 12-4 is on page 524. So if you want to look at that for a minute, please. You'll see that that gives you the various tests that you would perform with respect to testing the controls that were on page 523. So for purchases, for example, it says select a sample of receiving reports, right? So the receiving reports are when you receive goods from a supplier, you record the goods received on a receiving report. So you're going to take those reports, and it says what? Vouch to the purchase order and note the missing receiving reports, if any, okay? So you're going to select the receiving reports and vouch back to the actual purchase order. And next test says trace to inventory record of posting of additions. So you're going to trace from the purchase order to the receiving report. So that's going to tell you what was ordered was received. And then you want to make sure that the goods received have been recorded in inventory. So you trace those to your perpetual inventory records. Okay. All right. The purchase orders themselves, that first test, of course, you're trying to trace those to the receiving reports. If you find a purchase order but you can't find a missing receiving report, then that indicates, right, a breakdown in internal control, because remember, all three documents should be matched. Purchase order, receiving report, invoice should be matched. So when you're trying to trace from purchase order to receiving report and you can't find it, it's going to tell you the control is not working. Okay. Again, the next item, payments and other expenses, right? So that would involve a lot of different types of transactions. The first test says select a sample of payment checks, right? So you're going to look at actual checks that have been issued or possibly EFT payments. Secondly, it says scan for missing documents, okay? So missing numbers. So you want to look and see, for example, on checks, you'll scan to see our check number 2000 to 2005, are they all recorded or not, right? So of course, the numerical continuity of checks should be recorded and tested in the accounting system by management to make sure all checks have been recorded. The next item, it says vouch supporting documentation for evidence of accurate arithmetic, correct classification, proper approval, and proper date of entry. So here again, you're going to be looking at the matching of the documents, right? Do the quantities on the purchase order agree to the receiving report? Do those agree to the supplier invoice? With respect to the purchase order, the price we said we would pay for the goods, does that agree to the supplier invoice or not? Right? So we're going back and looking at the package that the client themselves verified as matching and actually see if it does. Right? And if it does, of course, if everything matches up, that tells us the control is working. So we actually have to go back and look at documentation, right, to verify that the control actually has been working. Okay, so we just mentioned as part of our test on page 524, the tracing to inventory records. And so that's what PowerPoint 19 is speaking about here. It says auditors need to determine whether they can rely on the accuracy of perpetual records. Now, again, this is assuming that the auditor wants to rely on perpetual records. Okay, perpetual records, again, are inventory records which are adjusted for every time there's a purchase or a sale. Right? So the test, the first bullet point says test over accuracy involving tests of the additions. Additions to inventory would be purchases, of course, and then reductions, issues of items that are sold. So we would have to, with respect to inventory records, we would trace right from the inventory record back to the purchase order, right, and to the receiving report. So were items added to inventory actually ordered and received? Yes or no? Then with respect to reductions, was the reduction of inventory proper or not? We would trace from the inventory reduction in our perpetual records to a shipping document or sales invoice, right, to make sure that the number of units for which inventory was reduced equals the number of units sold. In addition, the next point says testing needs to take place from a physical inventory to the accounts. The accounts means the general ledger or detailed accounting records, and from the accounts, meaning the general ledger or inventory records, to the physical inventory. Okay, so again, we have to ask ourselves, what is the audit assertion that we want to test? Are we testing validity or are we testing completeness? With respect to validity, which direction will we trace from? Will we trace from the inventory records back to the physical inventory, or will we trace from the physical inventory to the inventory records? Okay, so for validity, you're testing, is the recorded inventory correct or not, right? So what you want to do is trace from the inventory records to the actual physical inventory. So during an actual physical count of the inventory, if the inventory listing says there are 100 units of part A, I'm going to take that inventory list and go find 100 units of part A. Right? That's going to tell me that the recorded inventory is valid, right? It actually exists. On the other hand, if I want to make sure that all the inventory is actually recorded on the detailed inventory listing, then I'm going to just select at random different items of inventory that are being counted and trace the physical items of inventory to the detailed accounting record. Now, the way they do that, as inventory is counted in an actual inventory count, they have a tagging system, right? So you just have a tag. Usually the tags are about 2 inches wide and three inches tall, okay, 2x3 card. And they just write on the card how many units exist, and they put the card right on the inventory. And so people can walk around the plant and look at the card and say, yes, count the same number of units that are listed on the card. Okay, so again, depending on which assertion you're trying to verify, that tells you the direction of the test that you have to perform. Okay, so again, for validity, you would trace from the inventory record to the actual inventory itself. For completeness, you want to make sure, has all the inventory been recorded? So you would actually trace from the physical inventory that you observe to the detailed listing. Okay, so usually in the final exam, I ask the first few questions around we call this directional testing, right? In which direction would you test? And so you have to give thought to which assertion, right, is it that you're trying to verify to answer the question correctly. Okay, so we know that we have to assess the internal control risk in order to determine the effect on the substantive procedures. And so on this PowerPoint, as we saw in the revenue receivable receipt cycle, we're going to make a summary assessment about internal control risk. So we're going to do one of two things. We're going to say internal controls are strong or good. If internal controls are strong, that means our internal control risk, our audit risk, is low, right? Because the internal control system, if it is strong, should prevent, detect, and correct material errors in the financial statements. So if we have a good or strong internal control system, what effect does that have on our substantive procedures? Well, it means we can test fewer items, right? So we're going to have smaller sample sizes. It also means that we can do some of our substantive tests earlier in the year. We don't have to wait until the year end. We'll do some of our testing earlier. Okay, so maybe in the fourth quarter, right? Maybe in the third quarter even of the year. Okay. An item that we often do in auditing is if the internal control system is strong, we will count inventory before the end of the year. Okay, and then complete what's called a roll forward schedule. So, for example, if a client's year end is December 31st, and internal control system is strong, very often you'll count inventory at the end of September. Okay, you won't wait till December. You count at the end of September, and then you do what's called a roll forward schedule. A roll forward schedule simply says this: if you count inventory at the end of September, you take your September 30th balance for inventory. Then in October, you add your October purchases. You deduct your October sales. That will give you your October 31 inventory balance. Then you add November purchases, and deduct November sales. That will give you your November 30th inventory. And then you add December purchases and subtract December sales, right? So in each of those months, you'll have what you believe is your ending inventory number. And you'll compare, of course, an analytical procedure would be to compare the ending inventory balances to the same balances in the prior year, right? To make sure that they look internally consistent, or is there some unusual trend, right, that you might want to look into, okay? But it's very common in large companies to actually count the physical inventory before the end of the year. Now, if internal control is poor, right, that means the audit risk or internal control risk is high, because we're saying the internal control system will not prevent, detect, or correct material errors in the financial statements. So in that case, what's the effect on our substantive procedures? We are going to have larger sample sizes, right? We have to reduce our risk, so we have to look at more items. Also, more of our work will have to be done at the end of the year, right? We perhaps cannot count inventory at September 30th because the internal control system is not strong enough, right, to accurately record inventory purchases and reductions in the roll forward period from October to December. So in that case, we might be forced to actually count the inventory at the end of the year, okay? So again, where internal control is strong, you'll count inventory before the end of the year. If internal control risk is high, meaning internal control is poor, you typically count your inventory at the year-end date, okay? The goal, of course, for auditors is to try and move as much of their work away from the year-end date if they can, right? Because if you have to do a lot of your work at the end of the year, that's going to increase the stress, right, on the audit team and the stress on management, because they have to do so much work at the end of the year. Okay. Now, in terms of tying or agreeing our substantive audit program, the tests that we're going to do, which are substantive tests, to our internal control assessment, let's look at exhibits 12-7 to 12-9. So again, if you look at pages 527, okay, to 532, that's where these exhibits are. And you'll note, let's look at page 527 first. You'll see that this is an audit program, and it says the account covered is accounts payable and accrued liabilities. And so you'll see there's a number of audit objectives which are listed, and they're saying they're substantive audit procedures. So these are a list of potential audit procedures that we would do. You go over to the right-hand column, it says assertions evidence is related to, okay, E is existence, C is completeness, etc. V is valuation, etc. So depending on the assertion for which we want evidence, it will tell us which are the substantive procedures that we have to do. Now, just because there's a lot of procedures listed here does not mean the auditor has to do every one. Okay, this is where judgment comes into play. The auditor has to determine, based on their assessment of the internal control system, which of the substantive procedures are they going to perform. So on page 527, you see a list there. That's for the accounts payable, okay? If you go over to page 529, you'll see at the top of the page, there's a separate substantive audit program for inventory, right? Because remember, inventory usually is the largest expense in the income statement. So we have a separate substantive audit program for inventory because of its level of importance. Again, you'll see for inventory, there's a number of possible substantive audit procedures that you would do, again, depending on which of the internal control assertions that you need evidence on, right? Again, E is existence, C is completeness. So the various procedures, right, relate to the actual assessment over internal control. Again, there's no rule that says, you know, if you're looking at page 529, which of these tests do I have to do, the substantive tests? That's in the judgment of the auditor, okay? So normally, of course, clients' internal control systems don't change much from year to year to year. So in a normal audit, whichever procedures were done this year that are substantive tests usually are the same procedures that are done year after year, right? Because the client's system of internal control is not changing, presumably your tests would not need to change as well. But if a client changed their internal control system, right, then you may have to do more substantive tests. You may do fewer, depending upon whether your assessment of the risk is that the internal control system is better or has it gotten weaker. Then on page 531, again, at the top of the page, you can see where it says account. Then we're going to look at property, plant, and equipment, and intangible assets, and depreciation and amortization. Right? So substantive tests in that area, we're going to determine, do we have to go and look at invoices, right, for some of the typical larger purchases. We're going to test the calculation of depreciation and amortization expense, right? That's a substantive test done by auditors quite often, okay? So again, you'll see the reference, if you're looking at page 531, you see the list of substantive procedures. Again, to the right-hand column, you see assertions evidence is related to, right, the various audit assertions, which are listed there. In the columns further to the right, you see it talks about timing and extent. Right? It tells you when are you going to do the actual procedure and how many items are you going to look at. Right? And of course, there's what's called a working paper reference. So in the auditor's file, they're going to simply put this work is done, you know, at page 50. This work is done at page 55, etc. Right? Depending, of course, how many pages that they have in their actual audit file. So we see there's a substantive audit program completed, right, for each of the major components within the purchases payable payment cycle. Okay. Now, if you go back to page 527, just to highlight this again, at the top of Exhibit 12-7, you see it says example of substantive audit program relating to assess risk for accounts payable and accrued liabilities. So for accounts payable and accrued liabilities, we're typically talking about the expenses, right? The various types of expenses a company would incur and pay. If you go to page 529, at the top of the page, as we pointed out before, these tests relate to inventory, right, and cost of goods sold. And the same thing for page 531. Those tests relate to property, plant, and equipment and other assets, intangible assets. Now, you might ask yourself, why do we have a separate audit program for these three areas? Right? The first one is essentially for various expenses. The second one is for inventory. And the third one is for property, plant, equipment, capital assets, basically. The answer to that question is that with respect to inventory and with respect to capital assets, auditors usually put very little reliance on the internal control system, okay? Very little reliance. And the reason is this. They can usually perform substantive audit procedures much more efficiently versus relying on management system of internal control. If you think about it for a minute, let's think about property, plant, and equipment. How many capital assets does a business buy in a year? Most companies, it would not be that many items, right? It may be 4, 5, 6 major pieces of equipment. That's it. So in order to verify whether those purchases are valid or not, it's very easy to trace from the general ledger back to the actual invoice, right, for the piece of equipment. That type of testing you can do very quickly. It's also possible to test the depreciation calculation on that new equipment very easily. So auditors find that it's most efficient to test the capital assets on a substantive audit basis and not rely on an internal control system. The same thing for inventory. Inventory beginning of the year, that was audited last year, wasn't it? So we actually counted it. In the inventory at the end of the current year, we actually counted it more than likely, okay? With respect to purchases, yes, that's where the auditor may put reliance on internal control, right, in the inventory cycle. And in some cases, as we mentioned, where internal control is strong, they will actually count the inventory before the end of the year. But they're still counting, right? It's not like they ignore counting. They must count the inventory under generally accepted auditing standards. The reason for that, of course, is that inventory is material, right? It's a major part of cost of goods sold. It's a major part of affecting profit for the year. So auditors normally, of course, they are required to actually physically count the inventory. The only issue is, do we want to rely on internal control and count before the end of the year, or are we going to count at the end of the year because internal control is poor? Okay, so inventory is sort of a mix, right, between substantive procedures and internal control reliance. Again, capital assets normally is just what we call a substantive audit program. We don't put reliance on internal control because it's more efficient just to go and look at invoices, right, for typically pieces of equipment or other major assets which have been purchased. And then finally, with respect to expenses, right, the various types of expenses that businesses incur, yes, in that case, auditors do put substantial reliance on the client's internal control system. Why? Because there are many items, right, many smaller items which run through the purchases system. So because the number of items is large in a large company, the auditors will put reliance on the internal control system to cover off the audit assertions, right? Cover off management's assertions with respect to those expenses, okay? So that's typically the audit approach that occurs within this particular cycle. Okay, a continuity schedule, what I call the roll forward schedule a few minutes ago. So we've already talked about that. So that's where we, again, we count inventory, right, at September 30th, and then roll forward that balance to December 31. So I've already explained what that is. I called it a roll forward schedule. Sometimes it's called, as you see here, a continuity schedule. Okay, it's the same thing. We're counting at a certain date, for example, September 30th, and then rolling forward or showing the continuity, right, the items affecting that account from the count date to the year-end date when they're not the same date. Okay. The second bullet point mentions financial statement relationships in the continuity schedule can also be used to analyze the impact of the statements discovered during the audit. So what they're talking about here is actually looking at and performing analytical procedures in the roll forward period, right? So for example, let's say we count inventory at September 30th, and then we roll forward inventory in October. So we add in our purchases, right? We deduct our sales, and we get our October 31st balance. So we're going to compare that to last year's October, right? The purchases and the sales. Are they comparable or not? If they are, fine. If they're not, investigate why not. Also look at the gross profit, right? What was the gross profit last year in October? What's the gross profit this year? The gross profit percentage, right? What is the gross profit divided by sales? If that number last year was 58%, this year in October it's 58%, then it looks reasonable, right? If last year's gross profit in October was 58% and this year it's 48%, why is there a reduction, right? You're looking at the intervening period and comparing it to something, right? Comparing it to last year usually. And then you want to account for, why did my gross profit percentage drop, right, from 58 to 48? Maybe there's an error, right, in the October recording for the current year. Then you do the same thing for November, right? Look at the purchases, look at the sales. How does that compare to last November? Purchases and sales, comparable or not? If it is, fine, comparable. If it's not comparable, why? Okay. And then again, calculate your gross profit percentage for November this year compared to November last year. Do the numbers look reasonable? If they are, fine. But if they've changed significantly, you want to investigate why, right? And so your analysis of your relationships, right, what they're talking about here in the PowerPoint, the analysis of the relationships in the roll forward period, right, can lead you to possible errors that exist in the accounting system. Okay, so again, these are tests which point you into a direction, right, for further testing. They don't necessarily give you an exact answer on the issue. You have to investigate further. Okay, we're going to talk a few more minutes on a number of various items in this particular cycle. There's a few what the authors call special notes. And the first one you see here in the PowerPoint is about physical inventory observation. And again, this is on page 534 in the text. Just excuse me for a minute, please. My throat's getting dry. I'm just going to have a drink of coffee. It's better? Okay. So on this PowerPoint, it says the auditing procedures for inventory and the related sales accounts frequently are extensive in an audit engagement. Okay. We do a lot of work in inventory. Why? Inventory is a large asset, right? Within the current asset category in the financial statements. It has a major effect on calculating working capital and the working capital or current ratio. So we want to make sure it's correct. It also, of course, has a major effect on cost of goods sold and on reported profit. Right? So as the authors point out here in the PowerPoint, it says a material error or some form of irregularity in inventory has a pervasive effect on the financial statement. Pervasive effect, what does that mean? Well, they're saying that many accounts are affected if inventory is wrong. Right? So let's pretend our ending inventory on the financial statement is in a material error. So ending inventory is then wrong, right? If ending inventory is wrong, that means our cost of goods sold is wrong. If our cost of goods sold is wrong, that means our income before income taxes is wrong. If our income before income taxes is wrong, that means our income tax expense in the income statement is wrong. If our income tax expense in the income statement is wrong, that means our income tax payable recorded on the balance sheet or statement of financial position is also wrong. If our net income is wrong, because our cost of goods sold is wrong and our income tax provision is wrong, that means our retained earnings at the end of the year is also wrong. Right? So we see by one item being materially incorrect, it affects a number of different accounts in the financial statements. That's what we call a pervasive effect. Okay, pervasive effect. The next point says auditing standards require that the auditor observe inventory taking and make test counts. Okay, so what I said a few minutes ago, auditors must physically count the inventory. The only question is, do we do that at the end of the year, or do we do that at some point earlier than the end of the year? But we must do it. And the reason it's a requirement of generally accepted auditing standards is that inventory can be easily manipulated by management, right? So again, because management can easily manipulate it, auditors are concerned and want to determine that that did not occur, right? So the way to do that, of course, is to attend the physical counting of the inventory. However, when auditors do that, the PowerPoint states they seldom take or count the entire inventory. Auditors will not count the inventory 100%. They select test, right? So they want to test the process. So one of the things they do is review management's inventory taking instructions. So for a large company, right, management is going to issue instructions to the management team and other people doing the count in terms of the actual count process. So the auditors review that in advance to make sure it's reasonable and there aren't errors, right, contained within the instructions. If the instructions look good, then that's indicating there's strong control, right, over the actual counting of the inventory. If the inventory taking instructions are poorly written, or there's a lot of doubt or uncertainties expressed, then that implies that the control over the account will not be good, in which case the auditors would try and get the inventory taking instructions improved, or failing that, it means the auditors would actually have to conduct more tests. But they're not going to count the inventory 100%. Some reasons for that: one, it would take too much time. Secondly, usually auditors can, because of their familiarity with the inventory, there are some items which are more valuable, right? So we may have an inventory of $1 million, right? But a small number of items might make up a bulk of that inventory number, right? So we may have some units which are worth, let's say, $1,000 each, but then we'll have a whole bunch of units that are worth $1 each. So the auditors, by counting the larger items, right, that are of more value, they can cut off a greater portion of the inventory value by counting those high value items. Right? So that's typically what auditors do. They select high value items, count those 100% or a very high percentage, and then they just take a sample of the smaller ones, right? The items which, if they're only worth $1 each, it doesn't matter if there's a 10% error because it's not going to be material, right? It's only a small portion in the inventory. But for the high value items, you want to make sure that those items, of course, are counted accurately to ensure that your inventory balance in the financial statements is correct. Okay, so as I just mentioned a few minutes ago, the first thing the auditors do is, as the PowerPoint states, is look over management's inventory taking instructions, which is a control, right, in itself. Again, if the controls are sound, the auditors can rely on the instructions to produce a good count, right? But the auditors, as we were talking, also do their own test counts. Now, the auditors, they test in two directions, right? So it's a dual direction test. Why do they test in two directions? Because they want to verify two different assertions. First of all, does the recorded inventory exist? Right? Management has a sheet where they list all the inventory. Does it exist? So what's the direction in which the auditor should test? To determine existence, we test from the actual listing back to the actual inventory. Right? So management has a whole list saying that inventory exists. How do we know it does? Trace from the list back to the physical inventory and find it. Right? Remember, everything during a count is tagged by management, and the tags should be pre-numbered. Right? And so management accumulates the tag numbers by plant area. So it's easy when the auditors select the item, they know where that tag number should be. Right? It's in the southeast corner of the plant, right? So all the locations are designated in management's count sheets. It's part of the organization. So the inventory is easy to find because management knows the auditor is going to want to find some of the inventory. So they have to know where it is. Management itself, of course, wants an accurate inventory count. So they want to be able to trace and find problems. So existence, we're going to trace from the listing back to the actual inventory. How about completeness? How do auditors test for completeness during the actual physical taking of the inventory? So in that case, the auditors are walking around the plant, right? So they select a number of items. As they're walking around, take the tag number, count the items, and then trace the physical items to the actual list that management has, right? So to test completeness, you go from the physical inventory being counted to the listing. That will tell you that all inventory that exists is recorded. That's a completeness test. The validity or existence test is all the inventory actually exists or not. You trace from the listing back to the inventory. So even an actual inventory count, although it does take quite a bit of audit time, right, is a very good test because you can satisfy a lot of management's assertions, and the auditors can gain out of evidence about management's assertions very, very quickly with an actual inventory count. Now, in the PowerPoint, they also talk about valuation. So this is also important. We know valuation is one of the key, right, assertions made by management in the financial statements. They assert that inventory is properly valued. They assert that property, plant, and equipment is properly valued. Well, how do we know as auditors? Well, when you're doing the actual physical counting of inventory, you look around the plant and you observe things, right? And so if you see some inventory in a corner that has 2 inches of dust on it, you know that inventory hasn't moved in a while. Maybe the value of that inventory is less than cost, right? It should be written down. So you would make a note and talk to management about, hey, what's going on with that inventory? It's got 2 inches of dust on it. Looks like, it hasn't moved in a long time, and management may say, yes, we've already written that inventory off, or they may say, we need to write it off, right? That's our intention. So you would have to follow up and make sure that that inventory was actually written down to net realizable value, right? So it's observing while the actual inventory account is taking on to ensure that the proper adjustments are made for the valuation of inventory. Not only inventory, though, when you're walking around the plant, what else should you be looking at? You're not counting equipment, but you might be looking at the actual equipment, right, that's in the plant. Again, you may note that maybe there's an old drilling press that's sitting in a corner that's got a lot of dust on it, right? So you might say to management, is that drilling press still recorded as a depreciable asset? Because it looks like we're not using it, right? And so management may say, yes, that's been removed from service and we have removed it from the accounts that are being depreciated. Maybe that machine, right, is for sale and we have written it down to net realizable value. So you can look around, of course, for inventory adjustments during the actual inventory count, but you don't have to stop there, right? You can look around and, of course, at the equipment and make sure that it's all being used, right? Or if it's not being used, question management about why it's not being used, okay? All right, so I've been going for close to an hour now, so I'll stop for about a 5-minute break or so. I'll come back in about 5 minutes and we'll continue on, okay? We'll see you in a few minutes. Okay, welcome back, everybody. We'll continue on now, talking about inventory and a few other items connected to actual inventory counts. We already talked about the fact that sometimes inventory is not counted at the end of the year, and what the audit procedures are there with respect to verifying additions and removal of inventory. So that's what I was talking about, where you compare purchases and sales, for example, in October this year to last year. Same thing for November, same thing for December, right? So we're using analytical procedures to analyze the inventory movement from the count date to the year-end date. In addition, there's something called cycle counting. This is only for very large companies, and that's where an actual count of the inventory does not occur on a single date, but they'll use cycles. So, for example, the smallest amount of inventory in terms of value might be counted at the end of month 6, right, during the actual fiscal year. Then the perhaps high value inventory might be counted at the end of month 9, right? But as a point here, with respect to cyclical inventory counting, the auditors must be satisfied that the perpetual records, right, are reliable. So again, normally, even with cycle counting, you would time the count of the high value items typically 3 months before the end of the fiscal year, because the auditors cannot rely on internal controls, okay, with respect to counting of inventory or with respect to confirming accounts receivable or accounts payable for more than 3 months before the end of the year. So if the auditors want to test and send out confirmations for accounts receivable, not at the year-end date, but before the end of the year, they can only go back 3 months, okay? Same thing for inventory. If they want to count inventory before the end of the year, they can only do that 3 months earlier. They cannot go back earlier in the year. The reason for that is the profession's decided that no system of internal control is perfect. And if you count inventory or do your confirmation work for accounts receivable or accounts payable too far in advance of the year-end date, that creates more risk, right? That the internal control system is not working for a longer period of time. And the profession doesn't want to go there, basically. Okay, so 3 months is the earliest cutoff for counting inventory, confirming accounts receivable, and also confirming accounts payable. Now, sometimes, this is pointed out here, the auditors may not be present at the actual client's inventory taking. So in that particular case, the auditor has to review the client's plans for the completed count. Some test counts of current inventory should be made and traced to current records, determine reliability of the perpetual records. So if the inventory must be counted, but if inventory is not material, right, then the auditors may not be present, okay? Or if, let's say, you have a December 31 year end, but the auditors are not appointed until January, well, they've already missed, right, the inventory count. So in that case, when the clients record their inventory, you're going to want to look at the purchases, right? That's what they're talking about here. Go to the current inventory and look at the purchases just before the end of the year to build up, if you can, the inventory balance, okay? But very often, this is a problem. If the auditors are not present at the inventory count, this will usually lead to an audit qualification, right? Because if assuming inventory is material, if the auditors are not appointed till the end of the year, after the end of the year, they can't attend the count. And so how do they satisfy themselves on observation, right? And the fact the inventory actually existed. Yes, you can go and look at purchases of inventory, but how do you satisfy yourselves that the inventory was not sold before the end of the year, right? So this can create a real problem for auditors, and very often, as I said, there will be an audit qualification when they're not present to count the inventory. Again, it will depend on how material inventory is to the financial statements. Sometimes inventories are at premises other than the client's premises, right? So let's say the main manufacturing business is in Windsor, Ontario, but we also have inventory in Vancouver, in British Columbia. Maybe we have some inventory in the United States somewhere, okay? So we can't have inventory off the client's premises or their main premises. So what we do there, we have to determine how much, right, is at these different locations. Where are they? And then we have to look at internal control. So the next point, it says if amounts are material, so if inventory is material and controls are not strong, the auditor may actually want to visit the other locations, right, and do test counts. So this is very common. I've done this myself in the past. If you can't trust internal controls to produce a reliable inventory number, then you physically go to the other location, right? So if I'm in Windsor, Ontario, how do I go to Vancouver, BC? Well, I probably don't. If our firm has an office there, right, I call up my other office and have them attend. Or we may want to hire another accounting firm to go out and count the inventory for us, right, and send us their documentation on the existence of the inventory. So there's different ways you can do this, but you have to somehow attend that count, right, assuming that the inventory is material. On the other hand, if it's not material, right, so if inventory is not material on the balance sheet and the internal control risk is low, meaning that strong internal control exists, then it says direct confirmation with a custodian may be sufficient evidence, okay? So if the client says their total inventory is $10 million, but yes, we do have $50,000 at a warehouse out in Vancouver, BC, and there's a firm out there that's safeguarding it for us. Well, we just send a letter to the custodian saying, you know, is there $50,000 of inventory there on December 31st, if that's the year-end date? They'll write back and say yes, fine. If they write back and say no, well, then it's a problem, right? But because even if it's a problem, it's not material, right? So you may investigate what amount of inventory is there. Why did the client think they had $50,000 there when maybe it's only $20,000? So you investigate it, but it's not material to the financial statements. So yes, you can get outside confirmation, right, of the inventory, but only if it's not material, right? So very often, because again, the auditors are concerned about the level of inventory because it affects the cost of goods sold calculation. Normally, they want to attend the physical count themselves, right, which means they have to go to the different locations, or they'll hire another firm to actually attend at the other locations. Okay. Now, when they're actually doing the count of inventory, we know there are some other issues that auditors have to think about. So, are there consignment? Is there consignment inventory? Right. So, consignment means we do not own the inventory; someone else actually does. We're just selling it for them. Right. So, an example of this would be a pawn shop. Right. If a pawn shop has its year end, is all the inventory in a pawn shop owned by the pawn shop? No. A pawn shop often takes inventory on hand to sell for others. The pawn shop did not buy it. They don't own it. Someone else owns it. When they sell it, you're just going to get a sales commission, right, for the sale. So you have to be careful in some circumstances whether inventory is being held on consignment or not. Inventory being held on consignment does not belong to management or the company, right? It's someone else's inventory. So you have to make sure it's properly segregated, okay? Then for goods in transit, you have to ask the client, are there goods in transit? Goods in transit means, for example, if we're based in Windsor, Ontario, and we bought some inventory, okay, let's say in Japan, and it's being shipped to Windsor, Ontario, but on the year-end date, right, it's still in transit. Well, then who owns the inventory that's in transit? We would have to look at the shipping detail and determine were the goods shipped FOB destination or FOB shipping point. Okay, FOB shipping point means that when the goods were put on the boat in Japan, we have title to the inventory. So the inventory is ours. So we want to look at maybe the inventory doesn't arrive for 2 weeks, right, after the end of the year, but we're going to have to look at shipping documentation to make sure, you know, what was the count with respect to how much inventory was actually on the boat, for example. Okay, or if the goods were shipped FOB destination and they haven't arrived yet at the year-end date, well, then the inventory is not ours and should not be included in our inventory numbers. Okay, so inventory in transit, you have to be careful as well. The third item they mentioned, do we have inventory still on hand, which has been sold but not yet delivered? So that's typically what's called bill and hold transactions, right? So we have billed the customer for the goods, but we still have the goods. So in that case, for bill and hold transactions, you have to investigate, right, what's happening there. Bill and hold, generally accepted accounting principles, will allow you to record the sale, even though you still physically have the inventory, but you have to look at the contract between the parties, ensure that inventory is not improperly being held for some reason. Okay, it has to be segregated from the balance of the inventory in order to be considered bill and hold inventory. So there are some specific accounting needs that you would have to investigate in the case of bill and hold transactions to ensure that goods you physically still do have can be properly excluded from the inventory listing. Okay, so we want to next talk about a few special items with respect to property, plant, and equipment, and then we'll talk about a few items with respect to liabilities. So on property, plant, and equipment, it states here the existence of property, plant, and equipment, the completeness, meaning is it all recorded, and the ownership, do we own the assets that we've recorded, says are likely to have a low assessed risk of a misstatement. Low risk of misstatement because why? These assets are typically large, hard to move, right? We can't put them in our pocket and walk out the door, right? So because of their physical nature, the control risk is low, right? They can't be stolen, right? They're just too big. It would be obvious, right? If you're trying to move something out of a plant, you need a truck to move it, etc., right? So it's just not going to happen in most cases. Valuation, however, can be high risk, right? A high risk assertion, because it says there are many allocations and estimates involved. So with respect to buildings and various types of equipment, the estimates relate to what? What's the residual value, right, of the equipment? What's the residual value of the building? What are the useful lives of the assets, right? So with respect to depreciation calculations, those can be high risk assertions, right? Are they properly recorded or not? Okay. So the third point, it says the main presentation issues are to ensure that management's accounting policies for property, plant, and equipment are appropriate, right? That's based on a review of the accounting policies, and that they're fully disclosed, right? The necessary detail is disclosed in the notes of the financial statements, and that the categories and the appropriate monetary values of the property, plant, and equipment elements are presented in the balance sheet. So we want to know in the notes of the financial statement, do we have a breakdown between office buildings, warehouse buildings, manufacturing buildings, right? Office equipment, automotive equipment, computer equipment, right? Furniture and fixtures. We want detail on all those categories. We want to show the accumulated depreciation and cost of all those different assets in the notes of the financial statements on a comparative basis, right? This year to last year. So that users can review the data and analyze what's happening in those accounts, right? So usually in this area, we're very concerned about proper disclosure, whether the accounting policies are appropriate and whether they, of course, are being followed with respect to the calculation of depreciation and amortization in particular. With respect to property, plant, and equipment, the major financial controls that auditors look at are acquisitions properly authorized, right? So that goes back to the authorization controls we talked about earlier. Are assets purchased properly classified? So when the invoice comes in from the supplier, is the asset properly classified at that point? Okay, that's usually the point at which classification is determined. Is the depreciation calculations accurate? Okay, so auditors test on a substantive basis the property, plant, and equipment amortization, okay, depreciation to make sure it's consistent. And if you want to look in the text, if you look at page 542, you'll see what's called a continuity schedule, okay, for capital assets. So please do look at that. You'll see the various assets are listed on the left-hand side, land, building, types of equipment. And you do a continuity, meaning that you analyze the balance in the movement of the asset from the beginning to the end of the year. So you see on this page, 542, we start with the balance at December 31, 2000. Then we have plus what were the additions during the year, what were the disposals during the year. That will give us our balance at the end of the year at cost, right? And then we do the same thing for the accumulated depreciation. What was the accumulated depreciation at December 31, 2000? How much depreciation occurred during the year, right, or amortization? What were the disposals, if any? The next column, what were the impairments recorded, if any? And that will give us our accumulated depreciation at the end of the year. We calculate our net book value at the end of the year, which is our cost minus accumulated depreciation by category, right? And then we compare that to the prior year. So auditors have these schedules usually on a comparable basis, okay? So they can compare the detail this year to the detail last year, okay? That type of thing, okay? So that's what we want to have a look at, okay, as auditors. And just look at that continuity, and determine does it make sense or not in terms of how the amounts are moving. Okay. Control tests, it says, are generally performed in the underlying purchase payable payments cycle. Again, auditors typically, because of this, there's only a small number of transactions for capital assets. They usually don't put a lot of reliance on the internal control tests. More of it is based on the substantive procedures, right? Physical inspection of the assets, easy to do, right? Walk out in the plant, have a look at the asset. Recalculation of the depreciation, easy to do, right? If you had specialized equipment, you might want to get an expert to look at the piece of equipment, make sure it actually is what it says it is, okay? And then the last point says, inquiry is an important source of evidence for evaluating completeness, meaning are all the assets recorded or not, as well as aspects of valuation. So when you walk around the plant and you're actually looking at the machines, are they working? Right? Or if some machines are just sitting in the corner or just sitting silent and not being ran, why? Are they broken, right? Do they need repairs, etc.? Are there impairments? So just by auditing, by walking around, right, you can actually see a lot of things and inquire of management, right? Ask questions. Okay, so again, property, plant, and equipment, normally very little reliance on internal control because we can easily test the additions and the disposals substantively, meaning looking at invoices, right, for items purchased, even invoices for items sold, and then substantively test the depreciation and amortization calculations, right? So these assets are large dollar amounts, and so typically we want to reduce our risk by actually looking at the invoices, okay? And it's the most efficient way to do that part of the audit. Okay, the last part of this chapter zeroes in on liabilities because we know we have purchases payable, right, which is a liability or debt, and then payments. And we already mentioned at the start of the chapter that one of the auditor's main concerns is around whether all the liabilities are recorded or not. So that's what the last couple PowerPoints discuss in this chapter. Looking at the PowerPoint, it says, when considering assertions and obtaining evidence about accounts payable and other liabilities, such as income taxes payable or maybe lawsuits, right, that are outstanding perhaps, the auditors put emphasis on the completeness and obligation assertions, meaning that management says all the obligations are recorded. The auditor asks, are they? Management says all the liabilities are recorded. The completeness, the auditor asks, are they? Okay, so the emphasis is here because companies tend to be less concerned about recording expenses and liabilities. Why? Because normally they want their profit to be as high as possible. right? So the management has a bias to spend less time, right, devote less attention to ensure that all the necessary expenses and debts are recorded. So because that's a risk area, right, and management's incentive is to understate liabilities, auditors cannot rely just on management's assertion that all the debts are recorded, right? We have to go further. So the main test that auditors do with respect to liabilities is what's called the search for unrecorded liabilities. Right? So what types of audit tests could auditors perform in order to determine whether all liabilities have been recorded or not? So there's a list. If you go to page 543 in the text, you'll see at the bottom of that page and over to the top of the next page, 544, there's a whole listing there of things that auditors can do to determine whether liabilities are understated or not. So for example, a common test that auditors perform is they send out confirmations, right, to suppliers. And the confirmation will say, please advise us how much our client owes you at the end of the year, okay? Management signs a confirmation, just like they do for the accounts receivable confirmations that we talked about previously. So the supplier will write to the auditor and say, you know, your client owes us X dollars as at the year end. So the auditor will take that number, and let's say the supplier says your client owes us $100,000. The auditor takes that confirmation, looks at the client's records, and say, oh yes, they have recorded $100,000. So it looks like all liabilities are recorded. However, sometimes the auditor looks at what the client has recorded, and let's say it's only 80,000. It's not 100,000. Well, does that mean the 80,000 is understated? Not necessarily, because your client might have issued a $20,000 check on December 31st, the year-end date, and the supplier has not yet received it, right? The supplier wouldn't receive it until early January. But when a difference exists between the 100,000 and the 80,000, you ask management to reconcile the two numbers, and they would say, oh yes, here's a check for $20,000 we issued on December 31st. You would look at the copy of the check, make sure it's made out to that supplier, right, and satisfy yourself, yes, the amount is properly reconciled to what the supplier said. So sending out confirmations, very common audit procedure, done virtually 100% of the time. Not all the suppliers, right, are tested, just a sample. So again, normally you would take the larger suppliers, right, and send a confirmation to them, and then take a number of the smaller suppliers. Okay, so that's one way to look for unrecorded liabilities. Another way to look for unrecorded liabilities is to look at, if you have a December year-end, look at payments made in January. Right? If payments were made in January, you'll look at the supporting documentation to see, is that paying a December invoice? If so, was the December invoice accrued as a liability or not, right, at the end of the year? It should have been. If it wasn't, right, that gives you evidence that all liabilities are not recorded, which means you're going to extend your test further, right, and look for even more unrecorded liabilities. So looking at subsequent payments after the year-end date is a way to verify whether all liabilities have been recorded or not at the end of the year, especially if they're material. Okay. In addition, you might want to select a number of receiving reports, right, in December for the last 2 or 3 days to see if the goods have actually been recorded as a liability to the supplier. Because if you receive the goods, a debt should be recorded even if the invoice did not come in until the end of the year. Right, so this is a case where you have unmatched receiving reports very often need to be accrued, right, at the end of the year. Another test to look for major unrecorded liabilities would be to review the minutes of the board of directors. Let's say there's a lawsuit against the company, right? Well, no payments have been made yet, but you want to be aware that should a liability be recorded or not, right? It's a contingent liability. Do we have to record a debt? Do we need disclosure in the financial statements or not? So by looking at the board of director minutes, right, that's a very good source for identifying information as well. You might want to look at tax files. So in Canada, we have Canada Revenue Agency. In the United States is the IRS. Right? So whatever your tax authority is in the country where you're operating, look at the correspondence right from the tax authorities to see if they're talking about additional tax debts, right, that the company perhaps is going to be reassessed for that the company has not yet recorded. Okay, so that would also be a common audit procedure with respect to looking for unrecorded liabilities. Okay, so again, on page 543, 544, there's quite a lengthy list there of things you can do and look at. So please take the opportunity to read through that list. It's quite common again on the final exam. I'll be asking some questions around unrecorded liabilities because it is a high risk area, right, during the course of a financial audit. Okay. All right. Okay, sorry everybody, just had to, my computer froze up, so I had to go out and come back into the class. But again, the important point, I just want to make sure that you caught there at the end. Please do have a look at page 543 and 544, because again, that includes a lengthy list of the types of tests that you might do as an auditor in terms of looking for unrecorded liabilities. Remember, it's management's assertion that everything's recorded, but as an auditor, right, we take what management says, but then we have to gather evidence, right? And we gather evidence by looking at the various sources at the bottom of page 543, top of 544, to satisfy ourselves that management's assertion is correct, right? And that we can accept it, okay? So have a look at that. You very often, as I mentioned, question on the final exam with respect to unrecorded liabilities. Okay, so there are a number of other items mentioned here right at the end of the PowerPoints. This one, it says the audit of account balances consists of procedural efforts to detect errors, irregularities, and frauds that might exist in the balances, thus making them misleading. So again, we've talked about the fact that for capital assets, for example, we look at invoices, right? Very detailed testing. For purchases, typically we rely on the system of internal control, right, for recording of expenses. They're less material, right, in the financial statements. Inventory, because it is material in most cases, we actually physically count it, right? We don't rely on the internal control system. So we're doing all kinds of detailed testing, right, substantive audit procedures to satisfy ourselves that the balances in the balance sheet are correct. Right, capital assets, land, building, equipment, we look at invoices. We don't rely on the system of internal control. Inventory, we actually count it, right? Accounts receivable, even, we confirm them, right? Accounts payable, we talked today about, we confirm the balances with suppliers. So we're doing a lot of substantive tests where we do not rely solely on the internal control system. We rely on the internal control system in part, right, to reduce our extent of substantive tests, but we still perform the substantive tests, okay? All audits are a mix of internal control testing and substantive audit procedures. You must perform some substantive audit procedures on every audit. You cannot do an audit and solely rely on the internal control system. That is not allowed under generally accepted auditing standards. Okay. All right. So there's a couple more PowerPoints here that just talk about some of the cases, which again, at the end of chapter 12, you can certainly read those if you would like to. But what I'd like you to do is have a look at several of the discussion cases. And again, this is to increase your own knowledge about some of the detail the auditors do. So if you can look at discussion case 12-3, 12-13, and 12-18, okay? So again, over the weekend, I'll be posting solutions for those three cases. And of course, I'm asking you to look at those three cases because there may be exam questions relating to those types of cases that are discussed. And so by trying to actually solve some of the cases, that's going to give you some experience at actually doing and thinking the way that auditors think, okay, when they have to do their procedures. And again, as I mentioned, I'll be posting the solutions for those in a few days. So you can consider your own work, look at the solutions. If you see where you went wrong, right, that's great. If you need more help, please contact me, shoot me an email, and we can go back and forth on that so I can help you out further. Okay, thanks everybody for coming to class today. Have a good day today, and continue to be safe wherever you're located around the world. And I look forward to seeing you next week. Next week, we will be moving into the payroll cycle. Okay, the payroll cycle is actually fairly straightforward. We'll be talking about that next week. And then towards the end of next week, probably starting to talk as well about what the final exam will be looking like, okay, in terms of the format. I've had a few questions from people already. Just generally speaking, the format will be very similar to what you saw on the midterm exam, okay, just in a general way. But again, I'll give you some more specifics on that probably towards the end of next week or so, okay, because we know that's going to come up quickly. Thanks, everybody. Have a good day. Again, if you need help on anything, please send me an email, and I'll do my best to try and help you out. Okay, have a good day, and we'll see you next Monday.